Hello, greetings from Monaco to the participants of the 2021 Bogu Investment Forum and to all investors in China. Today we'll be discussing why trends are the most powerful drivers of investment performance. Before we begin, allow me to introduce myself. I began my career in 1996 in oil trading. I've acquired since then over 20 years experience trading stocks, bonds, foreign currencies and commodities. Over that time, I've developed the I system, which I believe to be probably the best trend-following model ever built. As a professional investment manager, I generated a continuous track record from 2007 to 2019, consistently outperforming my strategy benchmarks, including world's leading managed futures funds. During the 2008 bear market, when most investors sustained heavy losses, I was among the small number of managers who generated positive performance for my investors. In 2015, I published the book Mastering Uncertainty in Commodities Trading, which was rated 5 stars on Amazon. In 2020, I founded Craner Analytics in Monaco to provide trend-following decision support to investors worldwide. This year, I plan to publish the book Alex Craner's Trend-Following Bible. So a word about today's presentation. We'll be covering a number of important subjects, primarily uncertainty, which is the key problem facing investors and traders. We'll look at some methods investors have used to deal with uncertainty, as well as trends in financial and commodities markets. Then we'll look at the strategy of trend following and technical analysis of markets. I'll introduce our trend following model, the I system, and we'll wrap up with some practical advice for investors. So the most difficult problem facing all traders, investors and hedgers is uncertainty. Simply, we have no way of knowing what might happen tomorrow, let alone 5 or 10 years from now. As investors, we can only make decisions in the present, but the results of those decisions will depend on future outcomes. The success in investing will depend on the quality of decisions we take and execute over time. So, to deal with uncertainty, investors have generally used two approaches: quantitative methods and forecasting. We'll discuss each one in turn. So quantitative methods seek to identify predictive attributes in market data and to build trading algorithms to profit from them. However, there are significant risks inherent with quantitative trading, and the results are not always good, and this is what we refer to as model risk. Namely, quantitative traders, or quants, face two kinds of challenges in building trading algorithms: conceptual issues and software coding errors. The conceptual problems stem from the misunderstanding of data and the relationships between the observed patterns. Typically, what happens is that correlation is mistaken for causation. Take an example. If we identify that event B follows some observed pattern A 75% of the time, this does not mean that A causes B, or that there's a 75% probability that B will happen the next time we detect the pattern A. So to illustrate, suppose we toss a coin 1,000 times and we mark the results H for heads and T for tails. We would get a string of 1,000 characters looking about like this. And now suppose further that in this 1,000 characters we identify the pattern TTTHH 100 times, and that 75 times TTTHH is followed by the letter T. It would be correct to say that in our data sample, a T follows the pattern TTTHH 75% of the time. It would be wrong, however, to say that there's a 75% probability that a T will follow the next occurrence of the pattern TTTHH. With coin tosses, the probability of either result is always 50%, regardless of the patterns and correlations in our data. This example is easy to understand, but our ability to interpret market data is much more difficult due to their complexity. As a result, we often have conceptual errors, and quantitative models are often based on mistaken interpretations of data and flawed hypotheses. But even supposing that analysts formulate correct hypotheses, they face another important challenge. Namely, quantitative models are based on software code, and software programming is a very error-prone business. Even among professional programmers, they make between 100 and 150 errors per 1,000 lines of code, and sometimes those errors can be very difficult to detect. If you follow financial media stories, you might come often on stories about poor and sometimes outright disastrous results of quantitative trading. There is some empirical evidence, however, to show just how difficult it is to achieve success with quantitative methods. In 2006, world's most popular trading platform, MetaQuotes, began to organize automated trading competitions. MetaQuotes offered a $100,000 prize for the winning algorithms, and this prize over the next 6 years attracted 2,726 participants. However, of all these participants, only 567, or 21%, traded profitably. 79% of them lost money. So the other approach to trading, to dealing with uncertainty, is forecasting. Among professional investors, a large majority rely on forecasting for their trading decision. For that reason, vast resources are dedicated to analyzing markets and trying to predict future developments. This approach, unfortunately, also is unreliable, as we'll illustrate with a few examples. Our first example has to do with interest rates. And keep in mind, the interest rate on the 10-year Treasury note happens to be considered as the most important price in world capital markets. In January 2019, the Wall Street Journal asked a group of experts to predict the interest rate on US 10-year Treasury notes for mid-year and end-year 2019. So here are their predictions. Mid-year 2019, end-year 2019. The predictions range between 2.5% and 4.3%. At the same time, the actual interest rate on the 10-year Treasury note continued dropping, falling at one point below 1.5%. So as you can see, all of these forecasts were completely off and wrong. Our next example is particularly interesting. It has to do with oil prices, because oil market is the most important and most closely studied commodity market in the world. Every year, the United States Energy Information Administration, the EIA, publishes an exhaustive report titled International Energy Outlook, which provides long-term forecasts produced by the EIA and a number of world's leading research institutions. After many years of wide misses, the EIA began to project future price forecasts as a broad range of low and high prices. In the following chart, you'll see the EIA's 2014 prediction. This forecast is based on industry's best information from world's most highly reputed institutions. In this chart, the blue line represents the actual price of the Brent crude oil, while the gray lines represents the EIA's high forecast, reference forecast, and low forecast. As you can see, this forecast was badly wrong almost from the day it was published, and it has been almost completely wrong for nearly 7 years. It is still completely wrong. By today, the Brent crude oil price has recovered to about $50 per barrel, but this is still far lower than EIA's low forecast. Our last example has to do with stock prices, or the Standard & Poor's 500 index. So twice a year since 1946, the U.S. Federal Reserve Bank of Philadelphia publishes the Livingston Survey, which summarizes various economic forecasts by 31 prominent economists from the government, industry, and the leading financial and academic institutions. So in this chart, you see in blue the Standard & Poor's 500 index and the Livingston Survey forecast for June 2007 and June 2008. The gray vertical lines coincide with the survey publication dates, and the red and blue dots represent the economists' forecast for 6 months, 12 months, and 18 months forward. And as you can see, all these experts' forecasts were very widely off from what actually happened in the markets. I could show you many examples like this, but the reason I singled out these three is because they concern some of the world's most closely studied markets and forecasts that were generated by world's most highly reputed analysts and research institutions. So this leads us to the question, why is it that forecasting fails so regularly? Difficulties arise from a number of problems. To begin with, analysts have incomplete, biased, and untimely information to deal with. But also the sheer complexity of markets makes it very difficult to publish any definite forecasts. But there's a third effect which is less well appreciated by market participants, and that is the prevalence of groupthink among the experts. The following chart, to my mind, represents one of the best examples of groupthink. We already talked about the EIA, and this is their forecast from 2003. So in 2003, as the oil prices began their remarkable rise to new historical highs, the EIA's 2003 two-year forecast, so for 2005, were all submitted in the low $20 per barrel range. So at the same time, the oil prices more than doubled. The problem is that price forecasts, once they're published, have an impact on the organizations, on the reputation of the organization that published them. And so even if in 2003 some smart analyst correctly predicted that oil prices would more than double by 2005, their institution would have been unlikely to publish it. From the organization's point of view, it is much safer to be wrong along with everybody else than to risk straying too far away from the groupthink. So this leads us into another phenomenon that's related to the expertise and the forecasting, and that is the market narratives, which are being generated non-stop by the media. The market narratives create the illusion of expertise, namely the idea that we understand market events and that experts always have explanations for the way news events influence markets. The following example shows you the three headlines that appeared on my Bloomberg news page at the same time, one below the other. And if you read them, they say, yen rebounds, yen declines, yen advances, all bundled up with the definitive explanation for why these changes took place. The illusion is that cause and effect relationships in markets are all clearly understood and explained. And this in turn gives the impression that it is the news events that move markets. Well, I think that news events have some impact on market price fluctuations, but that impact is limited. In this example, I put together a daily chart of US 30-year Treasury bond, and I singled out some news headlines that coincided with these price changes. For example, jobs reports show economic growth. The 30-year Treasury bond price jumped. There's some news about OPEC, then Brexit negotiation, and so forth. And all these news might have some impact on the price fluctuations. However, the large-scale price events, where investors tend to make largest profits, shape up over long periods of time and manifest price trends. So here we see a 20-year chart of the 30-year Treasury bond, and all of those news events and all those headlines that we saw happen right about here in this region. And in fact, if you took any point, any day on this chart, there were some important news that were published and explained as market movers. But as you can see, the real large-scale price events unfold over long periods of time as trends. And this brings us to the next subject of our discussion, the idea that markets move in trends. Already 2,000 years ago, Sun Tzu identified trends as one of the three great avenues of opportunity. And we'll look at a few examples. To my mind, one of the most interesting ones is the price of gold in the 1970s. Prior to 1971, the gold price was fixed at $35 an ounce for over 30 years. At the time, because of the market imbalances that existed, it was inevitable that the price of gold was going to rise. But it was actually unthinkable that it might rise to $100 an ounce or more. But what happened over the next 10 years is that gold price increased 24 times and peaked in 1980 at $850 per ounce, which is a development that virtually nobody predicted. The next chart shows the long-term price fluctuations of Nasdaq 100 index. During that time, we had some important bear markets and some significant corrections. But during the bulk of those 50 years, we can see that the Nasdaq has been in a large uptrend that increased the index's value by over 100 times. Our next chart shows the prices for New York taxi medallions. Again, this is a 25-year chart. And as you will see, over those 25 years, the prices unmistakably manifested a trend. First, a long trend up, then a reversal, and then a significant sharp trend down, which tells us that we find trends in all kinds of markets, and that includes the collectible items, arts, wines, and similar. Our next example is familiar to investors in China, and this spectacular stock has done tremendously well over the last 15 years. Then there's Bitcoin, which has also had a remarkable rise over the last 5 years. And then there's a special case, the electrical car manufacturer Tesla, which has had an absolutely spectacular rise over the last 10 years. Already between 2012 and 2014, the shares of Tesla increased by 10 times. And since then, they've gone up more than 12 times. In fact, towards the end of 2020, Tesla's market share surpassed that of the next 7 large car manufacturers combined. So let's see how this dynamic shaped up. Over the last 10 years, the Standard & Poor's 500 index increased by almost 300%, but the car manufacturers have not been a great investment. If in 2011 you happened to invest $1 in the shares of Toyota, by the end of 2020 you'd have about $2. If you were unlucky to invest in Ford, you'd have about half $1. With most of the rest, you'd be breaking even, more or less. And let's see how that compares to Tesla. To make sense, we had to rescale this chart to logarithmic scale. Now, there's a reason why this case is particularly interesting for our discussion here. While it would be very difficult to justify Tesla's stock price on any rational valuation basis, it is the undeniable reality that Tesla had massively outperformed its peers in a trend that's held for over a decade. This is not an anomaly, but only a recent spectacular case of the recurring theme that markets move in trends. And once trends get going in earnest, they often eclipse all our notions about asset valuations, both on the upside and on the downside. So, if you had the foresight and the wisdom to buy some shares of Tesla in 2011 and to hold them for 10 years, you would have done spectacularly well. Unfortunately, not many of us have such wisdom and foresight. But what if you always picked winners? Suppose you systematically bought top-performing stocks regardless of what you thought about the companies in question, about their stock price, about their products or their management teams. Well, then you'd be on to something quite powerful, and this is what we call the momentum investing. Is the subject we'll spend a moment discussing next. So momentum investing is a variant of trend following. It entails systematic investing in the best performing stocks and holding them for as long as they outperform. You might ask yourself, how well does that strategy perform? And we'll look at the empirical evidence. So, London Business School researchers Elroy Dimson, Paul Marsh and Mike Staunton reviewed nearly 110 years of UK stock market data between 1900 and 2009. They simulated portfolios of top 20 of the largest 100 companies over the previous 12 months and compared them to the bottom 20 and the middle 60, recalculating the allocations every month. The next chart shows the results of their analysis. So the portfolios consisting of the bottom performing 20% of stocks would have turned £1 invested in 1900 into £49 at the end of 2009. By contrast, portfolios consisting of top 20% of stocks would have turned £1 into £2.3 million, which is a difference in compound annual return of 2.3%. The performance gap was even wider for all London stocks based on data from 1955 to 2009. The top quintile generated 18.3% rate of return on investment, while the bottom quintile only 6.8%. The authors then replicated this study on 18 global stock markets, and the results were striking and remarkably persistent in all but one of them, and that one exception was Japan, based on post-2000 data. And I'll ask you to please keep this example in mind because we will revisit the Japanese experience towards the end of this presentation. So the significance of Dimson, Marsh and Staunton study is that it offers very compelling evidence that trends are the most potent driver of investment performance over the long term. And so this brings us to our discussion of the strategy of trend following. So, trend following relies on a field of research called technical analysis. Technical analysis concerns itself with the study of price charts. It does not attempt to explain the mystery of markets, nor does it pretend to be a rigorous science. Technical analysis is merely a repository of decades of observations and experience by thousands of market practitioners. It relies primarily on human judgment, but it also uses some simple geometry and math within the framework of three core beliefs. And these three core beliefs are that price discounts everything, that history repeats itself, and that markets move in trends. We'll discuss each one in turn. So, technical analysis assumes that all information that's known and relevant to the value of some security is already reflected in its price. The belief that history repeats itself means that chart patterns, which were repeatedly observed in the past, will likely continue to appear in the future with similar implications for investors. Finally, the belief that market moves in trends simply means that when prices start moving in one direction, they are more likely to continue in that direction for some time than they are to reverse. And with that, we'll look, for investors who are not familiar with technical analysis, we'll look at some of the most common studies and indicators that we use to analyze markets. So the most common one perhaps is the moving average. It is simply plotted along with the price charts, and it helps us determine the direction of price trend, and at times it can give valid trading signals, as in this example, when price breaks below the moving average, that could generate a valid sell signal. Another very common and very useful study is the so-called Bollinger Bands. So here we see a price chart with a moving average. The Bollinger Bands are then plotted as a function of standard deviations above and below the moving average. It can be 2 standard deviations, 3 standard deviations, or some other parameter value. And Bollinger Bands can give us valid trading signals, as in this example. So what we see here is something looking like a downtrend. And if we use Bollinger Bands, we can say that in a downtrend, when the price breaks above the upper Bollinger Band, that gives us a sell signal. And so in this case, we can see that here, here, and here again, the Bollinger Bands would have given us a good sell signal. A similar study is a parabolic stop and reverse, which oscillates above and below the price fluctuations. And a parabolic stop and reverse has the attribute that as a trend move in the market progresses, the stop and reverse points get closer and closer to the price, which makes it a good way to take profits after a strong trend move. So what generally happens is that when the price breaks below the stop and reverse, that would give you a sell signal, and then when it breaks above it again, that will give you a buy signal. So we can see that here, here, as well as here, it would have given you profitable trades. We then have so-called rescaled studies. Perhaps the most common of them is the slow stochastic. So here we have the price chart, and the slow stochastic recalculates the price fluctuations in a horizontal range between 0 and 100. With slow stochastic, we consider that when price drops below 20, the market is considered to be oversold, and when it breaks above 80, we believe that the market is overbought, and that can give trading signals again, as in this example, when the market became oversold, that would have been a good buy signal, and when it becomes overbought, that issues a valid sell signal. A similar study is a so-called relative strength index. Again, it's a rescale study that recalculates price action on a horizontal range with RSI. The levels 30 and 70 are considered to be oversold and overbought, but the trading implications are similar to those in slow stochastic. Next we'll look at some of the price patterns in the price charts themselves. So in this chart, which is a US Treasury bond, we see several important patterns. First, we have an appearance of a pennant, which is a consolidation pattern that usually implies that a trend move will continue. It appears in the middle of the trend move, and so when price breaks out of the pennant, the implication is that the trend move will continue another once as the preceding move. A very interesting pattern is the so-called Andrews pitchfork, which is determined by 3 points, A, B, C in this chart. So basically, you take the cross line between B and C, and then you project a line from A through the midpoint between B and C, and then you project parallels to that line from B and C. And as you can see in this example, the Andrews Pitchfork has pretty well determined the price action for more than a year and a half. It's acted as a support and resistance levels at various points. Here we see another consolidation pattern called the flag, which also implies the continuation of the trend, and it appears around the middle of the trend move. So the implication being that when the price breaks out of the flag, you can expect another move about as large as the one preceding it. So again here we have the price which peaks almost exactly at the Andrews Pitchfork line, and then we have the large double top reversal formation. So first we have the higher top and then the lower top, and then once the price breaks below the so-called neckline here, that's a very strong indication that the trend has reversed, and as you can see, it has gone into a downtrend. In our next chart, we see again, this is the Swiss franc, we see a very clean downtrend, and then we see a very large head and shoulders reversal patterns. Like it's similar to the double bottom, but it has three troughs: a shoulder, a head, and another shoulder. And once the prices break above the neckline, that's a strong indication that the price trend is reversing. And as you can see, the price went from downtrend into an uptrend. The interesting thing about this head and shoulders pattern is that it contains a smaller head and shoulder reversal within it. Then we have the so-called channels, which consist of a trend line and a parallel. And as you can see again, this channel has contained much of this uptrend for 3 years. It's acted as a support level and also as a resistance level at various points. Here in the middle we have again a large pennant, a consolidation, which also implies that the trend is about to continue. Again, you have a move, a pennant, and then once the price breaks above the pennant, you have another move which is about as large as the initial one. And again here you have a double top formation and then the reversal of the trend. Our next example is a particularly fascinating study called the Fibonacci levels. Here you see a very long, straight, clean downtrend in coffee prices between 2011 and 2014. And so you get the Fibonacci levels, you take the top and the bottom of a trend move, and you project horizontal lines through the 38.2 level, 50% level, and 61.8% level. And so here what you see is when you have a sharp reversal in this downtrend, the first rally goes to about 50%, the next attempt peaks close to 61.8%, and then for the following year, most of the price consolidation happens in and about the Fibonacci levels, and the last attempt at reversal peaks again at 61.8% before this larger trend then continues. And here again we have a flag pattern occurring in the middle of a trend move. So as you can see, technical analysis gives us many different ways to analyze price charts. In any chart, we might see numerous elements that suggest compelling trading ideas. The challenge for a technical analyst is to interpret these elements correctly and to generate consistent quality trading decisions. In the words of Warren Buffett, what's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. To meet that challenge, we've built the I-System, which I believe to be perhaps one of the best trend-following models ever built. So I-System is the product of over 20 years of our passionate and uncompromising devotion to quality and reliability. We use the I-System in hedge fund management since 2007, and we consistently outperformed our relevant strategy benchmarks. I-System comprises a dual neural network of mathematical algorithms that codify a body of knowledge in market analysis and trading. The first network helps us determine the price trend in any given market, and the second network detects trend entry and exit points. All these boxes represent various mathematical algorithms, and together they are driven by some 70 calculation parameters, which allows us to formulate, test, and implement a very large variety of intelligent trading strategies. To give you a concrete example, let's consider again the moving average. At times, in media reports, we'll refer to 50 or 100 or 200-day moving average. And when you hear that a price in some market has fallen below the 200-day moving average, the implication is that the trend has changed. However, there is no special magic to the 50-day, 200-day, or any other moving average. The most useful parameter values will vary from market to market. So the I system uses moving averages to help determine the price trend. In our next slide, you see the daily price chart of a Hang Seng index with a 200-day moving average. In this example, we have a simple trading strategy. When the index breaks above the 200-day moving average, we buy, and when it falls below it, we sell. Using this simple strategy between 2005 and 2021 would have generated an average 12-month rate of return of 4.3%. But perhaps we could have done better trading the Hang Seng index with a different moving average value. To find out, we simply run this strategy with all values from 6 days to 300 days. And as it happens, with the Hang Seng, the best longer-term moving average is 131 days. It would have generated an average 12-month rate of return of 13.2%. We can use the I system to optimize also Bollinger Bands, trend lines, parabolic stop and reverse, slow stochastics, RSI, and many other studies. In this way, we formulate strategies which define the way I system generates trading decisions in almost any market. Every day and in any given market, I system strategies calculate a numerically exact measure of trend confidence and generate buy and sell signals. Once implemented, the strategies perform their function autonomously, reducing the complex work of daily market analysis to its final product, simple, actionable trading decisions. Even though each strategy is different because it might use different parameter values, they all have the same objective: to capture profit from large-scale price events and to limit losses from adverse fluctuations. We will look at a few examples of how this works in practice, and please keep in mind that most investors rely on forecasts for their trading decisions, because we'll be comparing I system performance to some of the forecasts we've already seen. So you'll remember this example. Wall Street Journal asked a number of experts to predict interest rates on the 10-year Treasury note for 2019. These are the expert forecasts, and this is what actually happened with the interest rate on the 10-year Treasury note. Now also keep in mind that when the interest rate on the Treasury note goes down, the price of the Treasury note correspondingly goes up. So in the next chart, we'll see how I system strategies perform. So in the top chart here, we see the price of the 10-year Treasury note. And here in 2019, as the Treasury note, as the interest rate went down, we can see that the price of the Treasury note went up. Here we see the performance of a set of 22 I system strategies, and the bold blue line represents their average performance. In the mid chart, we see the relative exposure of I system trading strategies ranging between 100% short to 100% long. So basically, what you see here is from 2017 through 2018, we have a long straight downtrend during which the I system strategies mostly traded on the short side, and that way they were able to generate a substantial gain on this downtrend. But then here you have a reversal, and as you know, it's a double bottom reversal. And as you can see, the I system strategies generally reversed from short to long and traded this whole uptrend through 2019 on the long side, again generating significant profits on this uptrend without having to know the future, without having to predict the interest rates or the price of the 10-year note, but simply by following along with the market trends. Our next example concerns the oil price again. And so here I put together the price of the Brent crude oil going back to 2014, along with some forecasts that have been published along the way. So here in 2014 and 2015, the oil prices declined by over 70%, And by January 2016, many research institutions predicted that oil prices would continue going down, and some of them even forecast the $20 per barrel range. But oil price reversed, and over the next 3 years rose to over $80 per barrel. By January 2019, Reuters polled more than 1,000 energy market experts to predict the oil prices 4 years out to 2023, and most of those predictions were in the $65 to $70 per barrel range. So that's about here, 4 years out. Then in January 2020, the CEO of Vitol, Mr. Russell Hardy, predicted that oil would trade between $60 and $70 for 2020. And so when oil price collapsed again, Vitol allegedly lost $1.6 billion. At the same time, here you see the performance of 12 individual iSystem trading strategies. And as you can see, over this whole period of time, they managed to generate a profit of over $96 per barrel. Another significant aspect of this chart that I'd like to call your attention to is the nature of trend following itself. What you see is that you have periods of sharp profits that are interrupted by relatively long periods of flat and even negative returns. And this is the nature of trend following, and it makes it a little bit like fishing, and that's the metaphor I'd like to discuss for a moment. So imagine that you have a small fishing boat and you specialize in catching tuna. And you know that in certain seasons, large schools of fish may pass in nearby waters, and during those seasons, you can land a large catch. The problem is that you don't know exactly where or when the fish will appear. So to catch them, you must set out to sea every day and cast your line. And this costs you some effort and some expense. However, from time to time, you're going to come across a school of fish, land a large catch, and at that point, you will recover your losses and generate some profit. Similarly, with trend following, we know that trends will appear, but not when or in which markets. So to generate profits, we need to continually position our trades in the direction of the anticipated trend. And our reward is that from time to time, a large trend brings us profits. Again, perhaps the best example is our trading in crude oil during 2019 and 2020. So as you can see, our fishing and positioning for the trend took more than 8 months, during which at some point we had a loss of over $10 per barrel. But once the large trend move materialized, iSystem strategies quickly recovered all the losses, and in the space of only 2 months generated profit of over $37 per barrel. So as you can see, the trend following strategies help us determine direction and timing of trades. If you do it well, trend following should improve your performance. Importantly, trend following can broaden your investing scope, because when you focus on analyzing price trends and the price charts, then you can invest in securities even if you don't know everything about them. Through my career, I have traded in more than 50 different financial and commodities markets, and I can confess that I know very little about most of them. So, for example, I know very little about the market for copper, but nevertheless, thanks to the iSystem strategies, I've been able to trade copper profitably. Here again is an example over the last 2 years, and as you can see, here's a 12 iSystem strategies trading copper. And over this period, they have generated fairly substantial profits, in spite of the fact that it took a relatively long time, and in spite of the fact that this process had some uncomfortable periods. And this then brings us to the question, because this is the price of taking risks. Why do we even take risks? Well, I think that ultimately all risk-taking rests on belief. For the fisherman, his efforts are justified by his belief that schools of fish will periodically pass within the reach of his nets. For the trend follower, the belief is that market moves in trends, and that with good judgment, well-formulated strategies, and discipline, he'll be able to profit from them. The willingness to take risk is motivated by the necessities of life, namely Fishing is necessary as a source of sustenance for the fisherman's family and for his customers. For investors, the investing is predicated on the need to generate return on one's capital. If money lays idle, it predictably loses purchasing power over time. I believe that the need to keep capital working productively was best expressed by St. Thomas Aquinas when he wrote that if the highest aim of the captain was to preserve his ship, he would keep it in port forever. As we know, people do not build ships to keep it in port or to preserve them, but to put them to work in profitable enterprise, and the same is true for every form of capital. Well, since we must take risks to generate returns on our capital, then we should look at some of the do's and don'ts of investing and of trend following. So to begin with, I would advise you to study technical analysis. As you look at hundreds and thousands of a price chart, your judgment will improve and your ability to pick out trading opportunities will sharpen. Use daily price chart. You will see interesting patterns and even trends in intraday charts like 5 minutes, 30 minutes, 60 minutes and so forth, but these will be relatively small price moves. Large-scale price events unfold over weeks, months and years. Do not day trade. Up to 95% of active day traders lose money. Target 10 to 15% returns. I believe that we would all like to double our money every year. That's a nice idea, but it's not realistic. Over the long term, globally, stock markets have tended to compound at around 10%. And among the best professional investors, they tend to achieve between 10 and 15% per annum. In some years, you'll see that some investors will get much more, 20, 30%, even more than that. But over a longer period of times, it tends to be between 10 and 15%. I believe that a realistic target will also help you determine how much risk you should take on your investments. Do not chase after losses. You will make some bad decisions in your life, some bad investments, and you shouldn't expect to always make profit on every transaction. I would be therefore very skeptical if anybody offers you investment returns that are very high. One error that investors make is that when they buy some stock and then the price of this stock goes lower, they often buy more in order to lower the average purchase price. Unfortunately, this can lead to greater losses. And as Warren Buffett says, if an investor is not capable of making peace with a 50% drawdown on any individual investment, then maybe they shouldn't be in the game of investing to begin with. Finally, and perhaps most importantly, always cultivate steadfast discipline. Before we conclude this presentation, I would like to point out one last reason why you should consider and why I advocate trend following as an investment strategy. Namely, trends eventually reverse and all asset bubbles ultimately burst, with no exceptions. I ask you to keep the Japanese experience in mind, and here's why. Japan had its great bull market in the 1980s, and as you can see, asset prices in Japan rose very sharply. But once that bubble peaked at the end of 1989, what followed was a 20-year bear market during which the prices of Japanese stocks lost more than 82%. Even today, the Japanese stock prices have not recovered the 1980s peaks. With trend following, you will know when to get out, but also when to get back in. So I would like to thank you for your attention. I would like to thank the Homily Group for giving me the honor and the privilege to address Chinese investors by inviting me to speak at the 2021 Bogu Investment Forum. In the near future, we hope that we can bring the iSystem trend following decision support to Chinese investors to better take advantage of trends in Chinese capital markets. Thank you again.